retail participation in the gold market didn't begin until 8 months ago. Over the last 2 months, you've seen retail dishoarding in the gold ETFs, a flow of funds out, not in. But you haven't seen any cessation of central bank buying. So you saw a transfer of gold holdings from European and North American retail holders to non-US central banks. What I think you're going to see next week is that the exodus of retail holders of gold, as measured by funds flows into the ETFs, will have turned around too. It may not be positive, it may be neutral, but I think that what you're seeing is that retail disintermediation out of gold has ended, while continued central bank buying of gold will continue to take the quote higher.
After piling into commodity gold exchange-traded funds as the precious metal rocketed to repeated record highs throughout 2024, investors are taking a breather. So far in December, investors have withdrawn more than $300 million from ETFs that hold physical gold. While this is a drop in the bucket compared with the roughly $127 billion in assets these funds have, it marks a change in investor behavior this year. They poured over $6 billion into these funds from March through the end of November. Veteran investor RickRule describes gold as essential insurance against the ongoing erosion of the US dollar's purchasing power. Based on fundamentals, Rick notes that while the US dollar remains strong relative to other currencies, Doug Casey describes it as the prettiest in the slaughterhouse. However, its absolute value continues to decline, supporting gold accumulation. Gold is still the universal reserve asset to which central banks, investors, and private individuals return in times of crisis. Since 1971, the average annual growth rate of the metal price in US dollars is just over 10%. Since the euro was introduced in 1999, the gold price in euro has risen by 356%, or on average 7.8% per year. While analyzing the market, Rick notes that gold's strength was driven by central bank buying, with retail investors only entering the market about 8 months ago. He predicts that recent retail outflows will stabilize soon, potentially turning neutral, as central bank buying supports higher gold prices. By the end of 2024, gold accounted for 10% of overall reserves held by central banks, up from just 3% a decade ago. While fiat currencies still dominate reserves globally, central banks increasingly consider gold a prudent element of reserve diversification. Now we present the clips of RickRule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think, too, that anybody who doesn't own physical gold is making a mistake. You don't have to own a lot. Traditionally, when gold performs, it performs so well that as insurance, a small premium buys a lot of coverage. But I personally don't see a circumstance where the deterioration in the purchasing power of the US dollar on an absolute basis, not relative to other currencies, doesn't increase. And in that circumstance, history suggests that a prudent accumulation of gold is on order. In the very near term, on the gold theme, I think what we've seen is relative strength in the US dollar relative to other currencies. And I think that continues. I think the US dollar is, to quote Doug Casey, the prettiest mare in the slaughterhouse when you compare it to the euro, the yen, the Canadian dollar, the Australian dollar. It's on an absolute basis, US dollar savings for US investors, that it becomes problematic. I think we saw softness in gold as a consequence of investor confidence in the US dollar with the Trump election. And I think that you've begun to see that euphoria retreat from the trade. Beginning about 8 months ago, you began to see retail participation in the gold market. Prior to that, for 2 years, all the strength in the gold market was central bank buying. If you look at inflows into ETFs, retail participation in the gold market didn't begin until 8 months ago. Over the last 2 months, you've seen retail dishoarding in the gold ETFs, a flow of funds out, not in. But you haven't seen any cessation of central bank buying. So you saw a transfer of gold holdings from European and North American retail holders to non-US central banks, which is to say the buyer that supported gold for the last 2.5 years has stepped back in the market, including the Chinese. What I think you're going to see next week is that the exodus of retail holders of gold, as measured by funds flows into the ETFs, will have turned around too. It may not be positive, it may be neutral, but I think that what you're seeing is that retail disintermediation out of gold has ended, while continued central bank buying of gold will continue to take the quote higher.
Regarding gold potential, RickRule underscores its role in preserving purchasing power rather than chasing short-term gains, like the six-fold rise from 1976 to 1981. Gold has managed to maintain its purchasing power, achieving broad-based gains and reaching all-time highs against major currencies like the euro, the British pound, the Canadian dollar, and the Australian dollar. Despite decades of economic stability fostering complacency, he predicts the next 10 to 15 years will be more challenging. While shifting towards silver, Rick highlights that silver's affordability and volatility tend to draw retail and opportunistic investors, especially from emerging markets. U.S. monetary easing and growing demand from industries like renewable energy, especially solar panels, have supported silver prices. Industrial uses account for more than half of silver demand. Meanwhile, supply growth, including from recycling, is expected to remain modest. Silver prices have risen 20% this year and are forecasted to increase by 7% in 2025 and 3% in 2026. The strong demand is likely to outpace supply growth, pushing prices higher. Let's get back to the interview.
I think one of the problems that gold bugs have is that they remember the period early 1976 to 1981, where the gold price went up sixfold or sevenfold in 5 years. From my viewpoint, I'm not looking at gold as a way to enjoy capital gains. I'm looking at gold as a way to maintain my purchasing power. So for me, when people say, when is gold going to move? I say, I think it's going to move beginning in the year 2000. In 2000, it was $253 an ounce. Now it's $2,700. That's 8.5% compounded for 24 years. I don't measure it in weeks or months. In the decade of the 70s, when the perception of inflation lagged the reality of inflation for 4 or 5 years, the writing was on the wall in terms of the deterioration of the purchasing power of the US dollar beginning in 1967. But the writing on the wall didn't translate into consumer action until 1972, 5 years or 6 years after the problem had been identified. I think what happened then is, and I'm making this up, by the way, I'm a credit guy, not an economist, certainly not a behavioral psychologist, but the period 1946 to 2067 was a pretty benign time. You know, the end of World War II, the lowering of interest rates, U.S. dollar hegemony on a global basis, the nifty 50, people were trained to buy the dips. I think we've been through the same period in 1982 to 2022, a 40-year period of really benign economic climate. And I think people's expectations of the future were set by their experience in the past. I don't think the world's going to hell in a handbasket, but I think that the period we have in front of us for the next 10 or 15 years is substantially less benign than what we've existed in for the last 40 years. I hope that long-winded explanation makes sense. My prognosis for silver has more to do with my experience, my observation. I don't, and I don't know anybody who does, really truly understand the silver market in terms of the why. I've been trying for 45 years. But what I do know how to do is observe. And my observation tells me that precious metals bull markets are led by gold. And when the generalist investor begins to be attracted to the precious metals narrative, normally because of the momentum established by gold, when that generalist investor comes into the metals market, leadership in the market transfers from gold to silver. So that transfer seems to take place sort of halfway through a bull market. And we haven't seen the transfer come to silver yet. And I don't know why the transfer does. I assume because of the reputation that silver has for more volatility, which attracts the greed buyer, and also for the lower unit cost, which attracts retail buying in emerging and frontier markets from holders who are unable to store wealth in gold. As I say, I don't know why it happens. I just know that it happens. The last to move traditionally have been the higher quality silver equities. And my observation has been that there is not enough market cap in that category to stand the inflow of generalist money when it happens. So the upside that occurs in the higher quality silver stocks is absolutely insane. To illustrate that, my first bull market was the 1970s, and I watched, but sadly didn't participate in, as an example, Coeur d'Alene going from 10 cents to $65. Not a typo. In the market in the early part of the 90s, I did participate. We financed Silver Standard at 72 cents. In 6 years, it was over $40. We financed Pan American at 50 cents. In 6 or 7 years, it was over $40. The upside that people who have the patience and the stomach to endure the volatility, the upside in the high quality, small silver equities is stunning.
The outlook for gold presents a mix of challenges and opportunities, with the precious metal poised for modest growth amid a dynamic global economic landscape in 2025, according to the World Gold Council. The possibility of gold hitting the $3,000 per ounce mark in 2025 appears feasible, but achieving this ambitious target depends on favorable market conditions. How should investors balance their portfolios between gold and silver in the coming years? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.